That, my friends, ladies and gentlemen, it is an all-time high right over here that we are about to close on. So that is 67,029. The previous closing all-time high. Now, these are closing all-time highs. These are not intraday all-time highs. Intraday all-time high is actually significantly higher from here. Well, maybe not significantly higher. We have it around 69.20. So we have 13 points higher on the S&P 500, and we're sitting over here at 69.07. So we're very close. We're very close to. I know, seriously. I'm always muted on this thing, like all the time. Always muted on this thing all the time on here. You can hear me now. I started, of course. I started the stream and I was muted, of course. And yeah, I mean, things are flying pretty good. I mean, if Amazon is making, if Amazon's green on the day and green on the year, I'm going to be in a good mood because that is a very big position portfolio. Always good to see the biggest position of portfolio. Very green today. Meta actually can't really quite catch a bid here. I mean, yeah, I guess 50 basis points up is not a big deal. Tesla's actually red in the day, but let's be completely honest. This chart has been vertical for the last couple of months, so can't really complain here for Tesla. I know a lot of you guys are big shareholders of Tesla, but that's doing pretty good. But that be it. We have a pretty good show for you guys today. We're going to talk about Trump's recent tweet that he had this morning, along with Steve Hassett, talking about rates on CNBC. Along with that, Tesla, the 2026 is going to be a big year for Tesla, says Mr. Daniel Ives. Google versus OpenAI. Which one is the better deal over here? Would you buy OpenAI at an $830 billion valuation? Would you buy Google at what is it? Let's Google that right now. I think we're sitting at about almost 3 trillion, right? 3.8 trillion. Wow, I was way off. I was off by just $1 trillion. We're sitting over here at Google, $3.8 trillion. Which one's a better buy? You guys tell me. We're going to get into that one. And finally, going to close out talking about some Bill McDermott on ServiceNow recent acquisition of Armis, which is a cybersecurity company. This is going to be a pretty interesting turn of markets. I mean, definitely a lot more interesting than it was just last week when, including myself, I got a little bit of bearish there. Obviously not long-term bearish, long-term bull. As always, the market does go up. It is made to go up 90% of the time. And just look at this monthly chart. Like, this is crazy. Like, does this look like something you want to short? I would not short this. I definitely would not short it. Maybe some strategic shorting opportunity might come up here and there, but long term, you just cannot be bearish. The United States stock market right here. So Raj says Google is always the better company, but hype determined their fate. No, that's very true. I mean, like, obviously the sentiment for Google just last May was that the company was going to be disrupted by AI. And did it get disrupted by AI? I don't know. We're going to look a little bit to that one later. But yeah, a lot of these stocks, like, it's really sentiment driven, right? Like, are you going to buy Rocket Lab here all the way up here at $77? Probably not. But just the other week, Rocket Lab was at $40. We basically made it double in a short period of time. So it's really more about, like, don't buy something when no one wants it. Don't buy it when everyone wants it. Don't buy Path when it's $20. Buy it when it's $15.73. Don't buy Ethereum when it's at $4,900 per coin. Buy it when it's $2,900. And I don't know, some of the stuff you just never buy, period, no matter where it is on the chart. But with that, then again, let's get right into the show. What is going on, everyone? Yes, I know I was muted. I'm not muted anymore. Hopefully not. What's up? What's going on, guys? Raj, good to have you here. Yep. All right. So let's get right into the show. But first, a little bit of housekeeping. If you're watching this from the Twitter, make sure you tune into the Wolf YouTube channel. That is where I will be exclusively streaming these shows starting in 2026. Even from my channel as well. I appreciate all 14 of you tuning into my channel, The Solid Finance, but head over to the Wolf Financial YouTube because that is where I'll be exclusively streaming the show. And of course, we're going to have all of our guest speakers, all of our collaborations on the Wolf YouTube Financial as well. Steve and Matthew Farley, the White House Quant, they're actually streaming right now as well. So if you'd like to spread a little bit of love there, go ahead and do that as well. But we're going to be doing all the collaborations, all going to funnel into the Wolf Financial, or at least I will. to the Wolf Financial YouTube. So go ahead and check it out on there. There's a lot more stuff on there. Also check out the Wolf Trading as well for all of you short-term traders out there. Now let's get on with the show. What we got first though was pretty interesting. Just this morning we had a little bit of an interview with Mr. Steve. I keep on calling him Steve Hassett all the time. NEC Director Kevin Hassett. Who's Steve Hassett? I feel like there's a reason why I've been calling him Steve Hassett. I feel like who's Steve Hassett? I don't know why I keep using Steve Hassett. I don't even know who this person is. I was sharing this screen. Yeah, I tried to look up Steve Hassett. I had no idea who that is. Anyways, guys, let's go ahead and play this interview. He had a little bit of nuggets there. So just a little bit of a background for you guys. Kevin Hassett is the leading Fed chair nominee from Donald Trump, according to the Poly Markets. He is the existing NEC director, the National Economic Council. So he knows how the economy works because he is a director, of course. But he is a dove. He is a very big dove, and that is very bullish for the stock market. So I'm going to go ahead and play this clip. Let me just actually make sure I'm sharing the sound here. All right, so I'm going to go ahead and play this.
From the White House to discuss is the National Economic Council Director, Kevin Hassett. Kevin, great to have you back. Good morning.
Oh, thanks. Great to be here. Yeah.
Walk us through what you thought was important and whether or not, I mean, it's a great beat. How much was boosted by trade elements?
Right. Well, it's really a fantastic number, and it's a great Christmas present for the American people. And, you know, I would say that the headline for me is two things. That I think the big macro trends that we're seeing in these numbers are, first of all, that President Trump's trade agenda is working. And so we got about 1.5% of the growth on 4.3 because we reduced the trade deficit. And then the other thing that I think, which is a big macro thing that we're seeing, is that the artificial intelligence productivity boom is really clearly in the data. And I guess you and I are old enough that we remember back in the 90s when the computer came in, that all of a sudden you had like 4% quarters all the time, one after the other, and it kept surprising people because they thought, oh, computers are everywhere but in the productivity data, but we're seeing it in the data, and we're seeing the same kind of regular surprises for market participants. And so we went back and we looked at every Bloomberg forecast for the main numbers since September and found that on average we outperformed the forecast 94% of the time. So if 94% of Wall Street economists are getting the macro trends wrong, they need to start to think about, hey, maybe Trump's policies are actually way better than we thought. And maybe the fake news that says all these terrible things about Trump policies should reconsider and grab their pencil and redo their economics.
It's a big step toward that thesis that productivity could raise potential in the years ahead, Kevin. It does have implications for employment, and that was something we talked about with Peter Navarro earlier this morning. Take a listen.
In an age of AI, where all the white-collar jobs are going away pretty damn quick, I think maybe it's a good time for people to think about having good blue-collar jobs.
Do we need to worry about white-collar jobs going away pretty damn quick?
Well, my good friend Peter, he I think is jumping ahead on that thesis a little bit more than I would. The bottom line is that the way to think about what we're seeing in the data for artificial intelligence is, regardless what your job is, just about any job from blue collar to white collar, AI is helping you be more productive at your job. And so there's a guy at Stanford, Eric Brynjolfsson, who's been studying case studies of how AI is affecting people. And he finds that the way to think about it is that people just have a great coach who's helping them be more productive regardless of what their job is. And so it is true that instead of seeing a job creation at the sort of 150,000 level, we're seeing it at the 60 or 70,000 level. It's a little lower than you would normally see at a boom time, but don't forget.
So what Steve Hassett is referring to is how you basically have a lot of jobs, probably not as much demand as we've seen in a while, but you have GDP on the other side of that. Let me actually bring up the GDP over here. Today, at the same time, we had, actually, no, that was not the one. I believe it was, where's my GDP chart? Well, can't find it. I think it was the I had it a second ago. You know what? Let me just do GDP now. Atlanta Fed. Yeah. So we had basically the Atlanta Fed come over here and say that they expect GDP for Q4 to be around 3%. Now, I guess the issue here that they asked them on CNBC was that you had the GDP forecast to be at 3%, but then you have jobs or you have unemployment around like 4.6, 4.7%. What is actually happening here? What they were asking him is, hey, are we having an issue with AI stealing a lot of these jobs, or AI basically putting a lot of people out of work, specifically white collar? When you think about AI, there's a lot of coding being written to basically automate certain processes and applications. And namely, what the worry is that a lot of these entry level type of jobs, where you have like people working help desk, you have people working at support calls, whatever, they can all be automated away. And even other white collar jobs that pay at a higher degree, developers and engineers specifically, those could be taken out through the use of AI and chatbots, whatever it is, right? And you wouldn't really expect jobs to be at this type of growth or type of decline if GDP is around 3%, right? You'd expect a lot of people to have jobs. You'd expect a lot of people to make a lot of money at work and everything, to be spending whatever it is. But it's kind of painting a different picture, as you heard from the chief counselor to Trump, Peter Navarro, is that this is something that we're starting to see. So in my opinion, and also in the Fed's opinion as well, you saw from the summary of economic projections from the last meeting, was that they basically expect unemployment to top around where it is right now and to start to pick up again. Not unemployment, but for jobs to pick up again. And if that's really the case, that would really help with GDP staying above 3%, which is around the point where they forecast their GDP to be, and to continue cutting rates into there, of course, when Kevin Hassett does come into his position, if he is the true nominee. Actually, speaking of which, we did have Trump do a nice little post for all of us this morning. I'm not sure if that helped bring the market back to its highs today, but we have over here that Trump basically posted about the stock market and GDP data and the next Fed chairman. He basically said that GDP is up 4.2% as opposed to predicted 2.5%, despite the downward pressure of the recent Democrat shutdown. And he said the market is basically made to go up. However, it still gets sold off on great news, and that's into more cuts coming in. He doesn't specifically say who his new Fed chairman he's going to nominate is, but he's saying that the new Fed chair definitely will not be destroying markets, and then that there will be additional rallies to come up. So, he's going on his little tangent that he usually goes on Truth Social. But at the end of the day, what he's pretty much saying is that buy stocks, right? Like, he's been saying buy stocks for a long period of time, and that is what he's continuing to say, buy stocks. So when the market goes down, he says that it's basically not anything that they're doing that's making the market go down. When the market goes up, he takes full credit for it. I mean, that's just the way that these politicians usually are. But at the same time, it's like, hey, man, markets are built to go up 90% of the time. So why short it? Why sell stocks? Why sell stocks? Because I guess that's the thing he's going for. Thank you very much, Eva Tronic. Much love and happy holidays, Wolf fam. Yeah, guys, if you haven't tuned in, Eva does do an early morning UK show for the EU participants in the stock market. Go ahead and tune into that one. That's actually a Spaces that's on Twitter, and that's hosted from the Wolf Financial account. So go ahead and check that one out. The recordings are available. I believe that is Tuesday and Thursday morning. So that's 4:30 a.m. my time. It's around 7:30 a.m. Eastern time. So go ahead and tune into that one. Don't even ask me what time zone that is or what time that is for UK, because I have no idea, man. We are the only nation in the entire world that still practices this crazy daylight savings time. So I can't even tell you which time zone that it is outside of the country. So all 17 of you people on my channel, thank you for participating. Wolf Financial, we got 7 people on Twitter. I don't even know how many we got, and I think we have several hundreds on there. So thank you all for watching. Again, if you are on here, tune into the Wolf Financial YouTube channel, youtube.com/@Wolf_Financial. Going to be on there starting in 2026. All right, so let's move on to the next topic here. We have Tesla. Tesla has been on a crazy rampage, insane rally for quite some time here. Actually, I would say specifically, let me just share the screen of the Tesla chart over here. And that is Ethereum. That is definitely not the chart I want to show right now. That has been on a massive sell-off lately. Yes, so Tesla sitting over here at 488. It's pretty much at all-time highs. Like, I'm not going to argue with that. Maybe like 1-2% away from all-time highs. The stock does have a very high beta, so you can expect massive swings in the up and down direction on a daily basis. But Tesla is sitting here around all-time highs. Now, I think the question is, why are we at all-time highs today, and why weren't we at all-time highs a couple months ago when the market was still near all-time highs? And I think the biggest thing that we need to take away from this is that Tesla does not move based on it doesn't move based on financials. It definitely does not move based on financials. Like, it is just declining revenue every single year. Maybe it's up or down by a single digit point in terms of revenue growth, but it's you're not investing in Tesla for the profitability. You're not investing in Tesla for its free cash flow, which it's actually, I think it's free cash flow negative now. You're investing in it for the future, right? So if you're buying Tesla today, you better have a long-term holding period, because that screen just actually disappeared. And there's actually quite a few things that Tesla does have coming into 2026. They have the robo-taxi, which you did hear about the outage in San Francisco in terms of the Waymos. I think that was more attributed to an internet outage, and because the Waymos are connected to whatever central nexus they're connected to, they do malfunction and go offline when that happens. Tesla, the entire neural network is embedded into the car locally, so it doesn't necessarily need the internet connection to function in full self-driving. So I think that had its benefit over it. But also on top of that, when you think about SpaceX coming public, Tesla is the only, I would say it's the only proxy to own SpaceX directly without actually owning it, by owning the Tesla stock. I mean, you've seen this momentum that Tesla's been having lately, and it just got a lot stronger when SpaceX announced their $1.5 trillion IPO. And then you also saw the same thing with Rocket Lab. Rocket Lab got a big boost from that IPO announcement. It's up 95% in just a matter of a couple of weeks. But Tesla, of course, is the stock you want to hold on to if you want to be a part of robotics, you want to be a part of EV expansion, you want to be a part of battery expansion, you want to be a part of space exploration until SpaceX does go IPO. There's a lot of things going on for Tesla, but most importantly, you don't buy Tesla when everyone wants to buy Tesla, okay? If your time frame is like 5 decades, it probably doesn't matter where Tesla is trading. You just want to buy it and hold on to it for 5 decades, right? Whether you buy it at $400 or $500 doesn't really matter. But right now, in my opinion, I wouldn't be banging calls into Tesla right now, only because like we're sitting here at all-time highs. It already made the move, and everyone wants to own Tesla right now. The time to buy calls in Tesla was when no one wanted Tesla, when Trump and Elon Musk were having their beef with each other. That was a time to buy leaps on Tesla. Now, I'm not really so sure anymore, especially when the market is sitting here near all-time highs. So let's take a look at what Mr. Daniel Ayers has to say about Tesla. It's actually a pretty short one. Let me open this up right here. That's not the interview. Oh yeah, that is the interview. Okay, let me just open this up.
And on Tesla. Now, outside of NVIDIA, I love what some of the thoughts you've been putting on your X account, Dan, on Tesla. Now, I'm sure you saw the photos of Waymos getting stuck in San Francisco with the power outage, and my first thought was, this is everything that could go wrong with the Tesla robotaxi.
Look, my view is 2026 is going to be probably the most important year, I'd say maybe in its history, for Musk and Tesla. Because, look, the autonomous chapter now comes to Tesla. 30 cities where we see robotaxis, ultimately in the United States. Are there going to be issues? Are there going to be speed bumps? Could there be delays here and there? Yeah, I mean, obviously you saw the blackout in terms of Waymo in San Francisco. But look, I think next 3 to 4 years, 20% of vehicles are going to be autonomous. And I think that ultimately is where it's heading. And that's why I think when it comes to physical AI plays, the best physical AI plays in the world are NVIDIA and Tesla.
So, I mean, he's right? If we head toward full self-driving, right, which is definitely taking a big bout today, but I would really argue that it does need a little bit of work before we're actually there. We did see those reports of seeing some basically seeing empty Tesla is driving on its own, not necessarily the or the cyber taxi we've been hearing about, or robotaxi we've been hearing about. But you know, that like that light gold one that we saw in the presentation. But you did have these Teslas driving itself with no one in it in Texas. Is that going to take advantage? Is that going to be taken advantage of anytime soon? I don't know, man. Like I would not get in a Waymo. I would not get into any type of those cars if I was going like a very metropolitan area for now. Maybe like a test drive on it outside and whatever. But other than that, like I don't think it's there yet. But just seeing how quickly technology is progressing in the last couple of years, I wouldn't be surprised if, like what Dan is saying, by 2030, you're going to have 20% of the cars utilizing some sort of autonomous driving in some way, shape, or form. And Tesla is the leader in that. I mean, if you have a car that doesn't need additional devices or even hardware, specifically LiDAR, in order to function on its own without any interoperability of a human driving the car, it's probably going to be a Tesla, right? It doesn't need LiDAR. It doesn't need anything. It just needs camera and vision, right? And these cameras are definitely getting a lot better. The algorithms that Elon Musk is creating in terms of the robot that's functioning Tesla, or the AI that's functioning Tesla, is getting a lot better, right? You have all these Teslas on the road, one of the best selling cars in the entire world, continuously gathering data. So they have the stack of miles that they keep on showing every single quarter for the autonomous driving. If you think about data that's being gathered in terms of autonomy, it is Tesla. It's been on the road for the last 15 years, and it'll continue to be spreading like a wildfire around the entire world. Google's a bit different because it's only attached to the Waymos themselves, and it's only in select cities. Tesla's, even though they're not self-driving, it still is collecting the data all the time. And I think that's the advantage that Tesla has over all of these EV companies for autonomous driving. And I think that that's probably the reason why it's sitting at all-time highs. And that's probably the reason why it's going to be pushing all-time highs, maybe like not on a daily basis. You're going to have your pullbacks, your ebbs and flows with Tesla in the short term, near term, and whenever it is. And it won't be a straight line up. But at the end of the day, this is the reason why they're the leader in it, because they're collecting the most amount of data and they're utilizing it in the correct shape and form, right? That is the reason why you would own Tesla, in my opinion, as far as the stock. And also you have your robotics, or you have Optimus being pushed out there. I think we were saying that they're going to start deploying them in 2026 or 2027. So there's a lot of excitement built around it. But at the same time, you know, the short-term trading when it comes to Tesla, it's very difficult to jump on that bandwagon right now that we're sitting at all-time highs. The move has already been made, in my opinion, or at least the big move in a short period of time has already been made. Now you have the very high IV with these options. You have to basically pay for the premium up front and so on. So that is what I got to say about Tesla. The next thing I want to talk about is Google and ChatGPT. So we had this graph released today. I'm going to go ahead and share my screen. Right. So we have this chart over here, which is basically showing the month over month traffic change for a lot of these chatbots. And I wouldn't really expect Anthropic's Claude, or even character. I never even use character AI, to be honest. Perplexity and so on. I wouldn't really expect these things to like start massively growing, because the most popular chatbots out there is really OpenAI's ChatGPT and also Gemini. And you see over here that Gemini basically grew 10% month over month, and Grok actually grew 14% month over month. But the law of large numbers, Grok is only 3.5% of the entire traffic share. Gemini is about 11%. And Gemini has actually been increasing for a long time. Of course, you're going to have ChatGPT all the way up there. I don't know why maybe OpenAI.com is up there, because OpenAI does have the API that's available for applications, but that usage is starting to go down, actually down 35% in just the last month. That would actually that would give up like 2% of its market share, which is pretty cool. Maybe like 1% of the market share. But ChatGPT went down 6.5% in just 1 month. And I don't think that trend is going to really reverse anytime soon. I think that trend is going to continue going up for Gemini and going down for OpenAI, not because of the fact that OpenAI is going to go to zero, but because OpenAI is 66%, 67% of the entire traffic share for chatbots. So if you have Google or Gemini only 11%, that's a lot of market share to take, especially when it is voted, especially on the poly markets, when you have the best AI model of 2025 as Google by a landslide, 98%, right? So if 98% of the people who are putting their money in saying that Google has the best AI model, or Gemini specifically is the best AI model of 2025, then this chart right here, Gemini is going to take more market share, right? So I would even argue, even from like my own standpoint, is that I've been using ChatGPT probably for the last 2 or 3 years, very like a lot on a code level, on a chatbot level, whatever it is. It's great. They obviously started the whole movement when ChatGPT 3 came out in 2022, and it's only gotten better. But Gemini is very fast to return your results. There's a lot of things that I do like about Gemini, especially when it comes to coding as well, that it's a lot better than that. The only thing that's stopping me from changing is the fact that I have put my entire process and gotten so used to using ChatGPT that it'll take me a little bit of time to transition over. But I am going to make that transition over at some point, and I'm not the only one who's thinking this, right? You have 10% of the month-to-month traffic change that are thinking the same thing as well. And this chart, this was like 3-5% of the market share just a few months ago. And look at it now. It's around 11% of the market share, and it's growing 10% month over month. I would actually think that by the end of 2026, Google Gemini is probably going to be around 20 to 30% of the entire market share, maybe even more than that. ChatGPT might be around 50% because they're still going to maintain the majority of it, of course. But then you're going to have these other AI models getting better as time comes, right? Like as these other models get better, people will find certain things about these other models that works most for their own processing, that they're going to start using them more. But that's not to say that's like basically saying NVIDIA is going to lose all of its market share. It's not going to lose its market share because the traffic share, the entire TAM when it comes to chatbots, is growing so rapidly that there is enough cake to eat. Like OpenAI is not going to go to zero, but they are going to lose market share. And I think that is enough to big Google up, and that is enough to basically put a ceiling on OpenAI's quote unquote compute margins that they're forecasting right now for next year. In fact, I do have an interview on CNBC here that I wanted to play from the OpenAI compute margins. I'm going to just share that screen over here.
OpenAI is getting more efficient at running its AI. Our Mackenzie Sigalos has that story for us. Hi, Mac.
Hey, Mike. One of the biggest questions for OpenAI right now is whether it can make ChatGPT profitable at scale, and that comes down to how efficiently it can run the models. A source close to internal financials tells me OpenAI's compute margin on paid products, we're talking both ChatGPT and the API, jumped to about 70% in October, up from roughly 52% at the end of last year, and about 35% back in January 2024. Now, they're attributing it to a year-long efficiency push, squeezing inference costs, keeping GPU capacity tighter, and routing traffic to the right models so that expensive compute isn't wasted. Now, the contrast with Anthropic is striking. The information reported they started last year around negative 90% on compute margin, but its internal projections suggest it could eventually beat OpenAI on total server efficiency once you include training and the cost of serving free users. And that's the pressure point for OpenAI. The free user base is enormous. And even at around 70% on paid products, that's still well below the kind of margins you see at mature software giants, where adding another user, even a free one, costs very little. Which brings you straight to the funding question. Reuters reporting that SoftBank is pushing to close that $22.5 billion commitment to OpenAI by the end of the year. And they're doing that by raising cash, selling investments, and potentially pulling on undrawn margin loans backed by its stake in chipmaker ARM. OpenAI, remember, is one of SoftBank's biggest all-in bets yet. SoftBank's already liquidated its entire NVIDIA stake, trimmed nearly $5 billion in its T-Mobile US position, and cut headcount, all to fortify their posture in the AI arms race. Guys?
So, Mac, the efficiency gains that OpenAI is talking about here, right? It's trying to get more out of, every unit of computing power. I assume that also would translate back into, therefore, needing less power per search and per unit of whatever they're delivering. I just wonder if that's going to be the battlefront in terms of all these models, and maybe we don't have to extrapolate the massive power usage numbers that we've been seeing.
So there are a couple of factors that play on that front. So one, we talk a lot about the compute build out in the context of creating this fresh infrastructure. That's where that $1.4 trillion spending commitment from OpenAI comes from. And that's where a lot of these power concerns are derived from. But part of what led to this higher margin is the fact that the cost of renting GPU capacity has dramatically come down this year. And that's part of what led to these healthier margins for them on compute. And then, I mean, the other side of this, Mike, is the fact that the GPT-5 model, a key feature of that launch was the router, and people complained a lot about it, but it's a big reason that the compute margin moved higher because it routes traffic to the cheapest model that can still do the job.
Got it. Okay, so it isn't necessarily just that somehow they're able to use less juice. Mac, thank you very much.
All right, so, oops. All right, so I think this is the thing with OpenAI is that they're talking about cutting costs. They're talking about getting funding from SoftBank. They're talking about focusing a lot on enterprise, which is a very predictive and large recurring or annual recurring revenue to its top line. My problem is this compute margin argument, right? Like what are compute margins exactly? Like, obviously, I can go ahead and look it up and see what compute margins are, which is basically determining the cost from the revenue that they're specifically getting from these models. But is that enough to justify an $830 billion valuation? Or I don't know. I don't even know what the valuation's at, technically speaking. I did see a headline saying they're at $830 billion, but I think they're somewhere closer to $550 billion. Does it justify that for only making $10 to $15 billion a year versus Google, who's already printing free cash flow, who already has like 35% Google cloud platform margins, who's already even the third largest hyperscale in the entire world is growing north of 30%. And already their search and their ad revenue and everything, they're dominating it. Like, does that really justify having a much or having 1/3 of the valuation of Google itself? Like, I don't know. Like, you really need to see a lot of not only reacceleration and growth when it comes to OpenAI, but at least profitability, right? Like, at this point in the cycle, if they can't reach profitability by like 2027 and 2028, it'll be very tough to justify its existing valuation. Did we hit a top in OpenAI valuation? And if they go IPO, is it going to be able to maintain that valuation? Or are people going to sell all of their stock as soon as they get the opportunity once that lockout period ends? That's the biggest question when it comes to OpenAI, right? Like, would I buy OpenAI? Actually, I had an opportunity to take part in investing rounds for OpenAI in the last 6 months, and I didn't want to. Like, why would I want to buy OpenAI? But I think that argument is less to do with OpenAI, but that has more to do with the fact that I could probably see a much higher return trading in the public markets versus the private markets, at least for myself right now. But if someone asked me if I want to invest in OpenAI probably in 2022, I probably would have, but not in 2025. It's just like way too late to do that. And the same thing goes for SpaceX. I would not even touch SpaceX at this valuation. Rocket Lab is a lot more attractive. Not today, but maybe just a week ago, Rocket Lab was a lot more attractive back then. So congratulations to all of you shareholders of Rocket Lab. You guys are freaking killing it, especially those of you guys who are buying in the $4 range. All right, so the next thing I wanted to talk about over here is Amazon. So Amazon is sitting over here at, I would even argue this is actually a pretty I don't want to say cheap, but a cheaper valuation than it's been sitting at for some period of time. Every time Amazon reports earnings, their earnings growth actually is pretty substantial. They beat their last earnings at 24%, which is pretty good, but they're growing earnings at a pretty decent rate. Like, they're not growing earnings at triple digits or anything, but for a mega cap that's only a $2.5 trillion company, that's growing at 10% plus per year, that's growing at 20% for the largest hyperscaler of the entire year, I would argue this is a pretty attractive valuation for me. So let's go over at least why the valuation is pretty attractive. I got my fiscal.ai over here, and I want to go to Amazon. And there's a few things that I want to take a look at over here, right? We'll take a look at the valuation specifically later on, but let's break it down, all right? So last quarter, actually, I'm going to zoom this in for you guys so you could see. So last quarter, they came in at $180 billion just for the quarter alone. The last 12 months, they actually are they're the company that has the most amount of revenue on a TTM basis in the entire world right now. It used to be Walmart. Now I believe it is Amazon. And that alone grew at 13.4%. So what we need to remember when it comes to Amazon is that they have multiple businesses. Actually, App Economy, Amazon. This guy releases like really good charts when it comes to Amazon. No. Where is that? Q3 2025. Here we go. All right, this will be it. Oh, I can't get that over there. All right, let's see here. I'm going to open this image up in a new tab. Oh my goodness. What are you guys doing to me? Hold on, guys. This is probably what I'm looking for. This will give you guys a better idea of what I'm looking at. Oh, perfect. Oh, all right. All right, so that looks pretty good in your camera, or at least I hope. Hopefully, it looks pretty good in your camera. All right, so Amazon has multiple business segments. They have the Amazon online stores, which is one everyone, of course, hears about it at $67.4 billion just last quarter. Physical stores, which is growing at 7% year over year, which is pretty decent. I mean, I'm not really buying it for Whole Foods or Amazon Fresh and buying it more for the online stores and also AWS, but also advertising. Third-party sales, this is actually a much higher margin business for them because they don't necessarily have to produce the items or anything. They just basically take the items and drop ship it to a lot of people who are buying products in Amazon. Advertising, which is a very high margin business for them. I believe these margins are around 30-40%. In terms of operating margins, and especially as it scales out more, that's only going to go up more. That's at $17.7 billion. And that grew 24% last quarter. So you have a very high margin business that's growing very quickly. Subscriptions, Amazon has everyone by the BLLS, so I don't think that's going to be going down anytime soon. They can jack this up by $25. People are still going to stay with Amazon. There is no competition when it comes to Amazon subscriptions because you also get Prime, you also get Audible, and so on. AWS, the largest hyperscaler in the entire world. We just heard from OpenAI, or at least that interview we saw on CNBC, that the price of GPU rentals is becoming commoditized, which means that it becomes a lot cheaper to actually rent out this compute to people, which means that as long as you get cheaper prices, a lot more people will start using them because, hey, look, I can get double the amount of compute for the same price as I did last year. Let me buy more compute, and that those customers become a lot more stickier in the AWS circle, right? And that grew at 20% year over year, accelerating from 17 to 18%. So you have a $33 billion company that just brought in $33 billion last quarter that is expanding revenue by 20%, and it is actually projected to continue accelerating into 2026. So we have about a $130 billion run rate company. Just the company alone. This is the reason why I own Amazon. The biggest reason why I own Amazon, to be completely honest. The online stores and the advertising and everything, that's like a plus in terms of the valuation you're getting today, in my opinion. But everything else is growing at $1.4 billion, growing at about 8% year over year. And then when you look across this entire chart, which App Economy Insights does very beautifully, that was a $180 billion quarter, grew at 13% year over year. Gross profit margins aren't like amazing. It's about 52%, but operating margins are at 10%. Now, a lot of these operating margins or operating profit, if you look at this, is AWS, $11.4 billion. So more than half of the operating margins or operating profit from Amazon is coming from AWS. And AWS is a $33 billion business. That's half of Amazon.com, right? And that's growing at 20%. Amazon.com is growing at 10%. So probably about like 2030, you're going to start to see AWS becoming a very large part of the business. Right now, it's a third largest part of the business. It'll probably become the second largest part of the business. Amazon.com will still be the largest part of the business, I would say. But you're going to see margin expansion in operating margins. You're going to see margin expansion in net margins, which is at about 12% right now. And you're going to see these costs start to come down as soon as maybe by like 2027, 2028. They're going to start decelerating the amount of spending they're doing for AI. And they're also going to keep the costs under control as they start to deploy robotics. This is actually something pretty important to see from the long-term view of Amazon. So let's bring this back to fiscal AI, okay? Let's look at the gross from a closer numerical perspective, $20.2 billion. All right, so look at this. Look at the growth rate of AWS in the last few quarters. This is the fastest growing quarter that they had ever. Actually, not that ever, but at least very recently in the last couple of years. And in my opinion, it's going to continue to accelerate. The growth will still continue to get up there, which is going to keep its margins a lot higher. Now, let's go ahead and take a look at the North American revenue. This is something that we've seen a bit of an acceleration, a reacceleration, continued reacceleration in the last few quarters. And this is its largest business right now, right? You have $100 billion from North America. And then international revenue, which Andy Jassy has been talking about a lot. They are looking toward emerging markets and continuing expanding in emerging markets. They're expanding in Latin America. They're expanding in Southeast Asia. They're expanding in Eastern Europe, which, in my opinion, Poland is an emerging market. That GDP is growing pretty monstrous, pretty crazy. I my words kind of slipped over there. I don't even know what word I was trying to say there, but whatever. That's growing at 14%, even though it's a slight deceleration. I think a lot of that has to do with the US dollar depreciation. But that's continued to grow, right? So what's this company valued at right now? Let's go ahead and look at its trailing. Actually, I want to look at its forward PE. Take a look at its forward valuation over here. Let's look at its forward PE, right? All right, let me zoom out a little bit here. I'm going to take out COVID. COVID screwed, 2023 screwed everything up for me. Let me zoom in a little bit over here. All right, so Amazon trades at a 31 forward PE as it is, right? Is that right? 31 forward PE. 18. Oh, 18 is that one. Okay, so next 12 months is 31. I think this might need to be adjusted, but nevertheless, 31 forward PE. If we look on a historical basis, the last time you were able to get Amazon this cheap was around April 25, last April, right? So given that the stock is obviously like 50% higher, not 50%, maybe like 30% higher since last April, it was trading around like a 26 PE. Today's at a 31 PE, which is arguably like, it's considered pretty high, but they're not doing any buybacks. At least they're not doing any buybacks yet. And I really hope they don't start doing buybacks. Let's take a look at the forward operating cash flow. So you have free cash flow, which includes basically all the spending that they're doing. And then you have operating cash flow, which doesn't necessarily include that. And the reason why I'm using operating cash flow from a valuation perspective is because we want to exclude all the crazy amount of spending and investments they're doing to AI, because that's going to eventually stop, right? Amazon isn't going to bring itself to zero or go into negative free cash flow with all these investments. They're probably going to put it under control at some point. But we're looking at operating cash flow, because this will give us a good picture of how the core business of Amazon, or the business of Amazon, actually functions by returning cash to its shareholders, right? So that's at a 14 right now. Historically speaking, we've been sitting as high as 18, okay? So if we look at the last quarter of Amazon, how well that quarter was, and it's trading at only 14 times operating cash flow, let's bring up the chart that I just had over the weekend that's comparing valuations for a lot of the mega cap stocks. And no, that's not the one. I think I actually released it the other week. Rule of 40 breakdown. No. Let me search for it over here. Nah, that's not where it was. I had a chart that basically showed the operating cash flow. You know what? I'm just going to bring it up in fiscal.ai because this is where I get the data anyway. Let's see here. All dashboards. Mag 7. All right, price to forward operating cash flow. Okay, so we have Apple trading at 28 times price to operating cash flow on the forward basis. We have Google at 21. We have Meta at 13. We have Microsoft at 20, NVIDIA 28, Tesla at 98. That's never going to be a low one. And we have Amazon at 14. So Meta and Amazon are trading at a 14, 13.5, 14 price to forward operating cash flow, which means a lot. I mean, in my opinion, that speaks volumes. That this is probably the better thing to look at in terms of a metric to see the valuation for these companies, because a lot of them are spending a lot on CapEx right now. And the operating cash flow is not going to show you, or it's not going to factor that in, right? And what we need to keep in mind is that the cycle that we're in right now is definitely an investment cycle when it comes to a lot of these Magnificent Seven companies, because they're really investing a lot into AI. So if we exclude that from it, Amazon and Meta are actually the cheapest ones of this whole bunch. I mean, even if we look at a forward PE basis, Meta is trading at a 22. Google's at a 30, Amazon's at a 30. But I would argue that maybe Google might seem a bit more attractive for this metric. But I would argue that Google's doing a lot of buybacks. I believe Amazon's not doing any buybacks. I think Meta's doing buybacks, so they have a dividend or whatever it is. So like this kind of sets Amazon apart. Amazon, in my opinion, is just a growth stock that's disguised as a mega cap, right? It's a $2.5 trillion company, but it's growing at about 11, 12%, but its underlying businesses are growing pretty rapidly as well. And I think that that's going to continue reaccelerating into the next couple of years. And in my opinion, I think Amazon, I don't want to say Amazon's going to be a double probably next couple of years, but I think Amazon's going to be around $300 at least in the next couple of years, which would put it pretty up there. I mean, I would even say that it's very possible Amazon might be a $300 stock in the first half of 2026, as long as the market stays bullish. Again, like a lot of this has to do with the market staying bullish. If the market turns south in the next couple of weeks, Amazon's going to get hit, and so will almost every single other mega cap out there, because these mega caps are very sensitive to the dynamics of the market. In fact, they do determine the direction of the market. But when you have a lot of macro that's being painted in a bad picture, I mean, just look at what happened recently, right? You had Nvidia pull back below $170 recently, and now you see it at what's Nvidia at? Nvidia's at almost $190, right? And the sentiment really turned around with a lot of these stocks. So like things can really change overnight. It's not really changing for Ethereum or Bitcoin, but they're certainly changing for the mega caps today, because the mega caps are actually doing really well today. You have I was just streaming yesterday, and I was saying how you can't really have new all-time highs or a Santa Claus rally without the mega caps. And we're basically seeing that today. We're seeing Apple's up 40 basis points, Amazon's up 1.6%, Google's up 1.5%. The mega caps are pretty much green, flat to green across the board. But the thing that's really propelling it is Nvidia. It's up almost about 3% today. But we do need to see a little bit more work in this chart. It is good to see that Nvidia is trading above the EMAs, and that actually did close above the EMAs yesterday. But if we look at the simple moving average or the daily moving averages, it's actually trading above all the moving averages for the first time since just reported earnings. Remember this big red candle over here the day after it reported its monstrous earnings? It just got sold off. Well, today we're setting up for a pretty good bullish medium-term and short-term trend in NVIDIA. So is NVIDIA a buy today from a trading perspective? It looks like it actually is a buy today from a trading perspective. Amazon is trading above the moving averages as well. Google is above the 20-day moving average as well. It's good to see. Meta still needs a lot of work to do. It needs to at least get above this 200-day moving average over here. Microsoft, I don't know. I'm not buying Microsoft. I'm going to stay away from that one. Netflix chart just looks terrible, like just absolutely terrible. I think this has a lot to do with the Warner Brothers acquisition. If that goes through, shareholders will continue to not like that one. If it doesn't go through, you might see a big rally in this stock. You already see Larry Ellison backing the acquisition of Warner Brothers. So I don't know, man. We'll see what happens with that one. Apple just continues to go up against all odds. Tesla obviously is just really up there. We're seeing a lot of these mega caps come back, and that's really what you need in order to see the market basically close somewhere near their all-time highs. In fact, where are we sitting right now in the market? Yeah, we're sitting around new closing all-time highs. So we'll see. We will see what happens with that one. So as far as earnings go, there really is nothing on the block for earnings this week. I would say this is a pretty short week. Tomorrow, I believe we have a half day tomorrow in the stock market. I will be live tomorrow still. I wonder if there's really going to be much news to talk about. I'm sure the market will be widely available for new news to provide to all of us as investors in entertainment. We'll see what happens tomorrow in the stock market. I am going to be streaming tomorrow. I'm going to be streaming on Friday. Thursday, we are going to be off, and really appreciate you guys being on here. Again, for you guys, tune into the Wolf Financial YouTube channel, youtube.com/@Wolf_Financial. Going to be on there exclusively starting in 2026.